Welcome to this explainer, where we're going to build the ultimate investor's toolkit for navigating financial uncertainty. You know, uncertainty is literally the only constant in the financial markets. But as quantitative analysts, we don't just sit back and guess what's going to happen next, right? No way. We calculate it.
Okay, let's take a quick look at our roadmap. We are covering 1. Forecasting with expected value, 2. Measuring dispersion and risk, 3. Mapping future probability trees, 4. The total probability rule, and we'll wrap the whole shebang up with 5. Updating beliefs with Bayes. Let's dive right in.
It's literally the million-dollar question, isn't it? How exactly do we put a firm price tag on a future that simply hasn't happened yet? We have to make investment decisions every single day under immense uncertainty about the economy, about specific companies, and of course, asset prices.
So let's kick things off with our most foundational tool. Section 1, Forecasting with Expected Value.
Before we can even think about modeling complex futures, we absolutely need a baseline forecast. And we get that by taking the expected value, which is just the probability-weighted average of all possible outcomes. It's not just a gut feeling or a guess. It's a rigorous calculation that boils our central expectation down into a single, actionable number.
Let's use Bancorp's earnings per share as a real-world example here. Instead of throwing darts at a board, a good analyst assigns specific probabilities to distinct EPS outcomes based on deep research. So for instance, maybe there's a 15% chance of hitting $2.60, a massive 45% chance of hitting $2.45, and so on.
And here's where the magic happens. By multiplying each of those EPS outcomes by its probability and just adding them all up, bam, we land on a concrete expected value of $2.34. This one number acts as our mathematical anchor. It's our most rational forecast for Bancorp's earnings long before the year actually wraps up. But hey, what if that baseline forecast is wrong? How do we actually measure that risk? Because let's face it, forecasts are rarely perfect. Section 2. Measuring dispersion and risk.
To effectively measure risk, we first calculate variance, which captures the dispersion of outcomes around our expected value. We have to square the deviations, and that's absolutely crucial. Otherwise, positive and negative errors would just cancel each other out. But because variance leaves us with squared units, standard deviation steps in. We take the square root, and it brings the metric right back to a readable, real-world format.
Going back to that same Bancorp data, if we run the math, we get a standard deviation of 20 cents. To put that into perspective, it means we can expect the real-world EPS to fluctuate around our baseline forecast by about that much. It perfectly quantifies our uncertainty. So we now know our target is $2.34, give or take 20 cents.
All right, we've got a baseline and a solid measure of risk. Now, what happens when outcomes depend on a whole sequence of events? Let's move to Section 3, Mapping Future Probability Trees.
Think of this kind of like a giant puzzle where we map out conditional expectations. Imagine a final expected recovery of 75.5 cents. That number isn't just pulled out of thin air. It's systematically built by branching out through independent economic scenarios. Say Scenario 1 has a 75% probability and Scenario 2 has a 25% probability. From there, it branches out again into conditional recovery outcomes. It's an incredibly powerful way to see how sequential events compound into a final expected value.
As these probability trees branch out and get more complex, we really need a mathematical anchor so the numbers actually add up correctly. That brings us to Section 4, the total probability rule.
This rule is a real game changer. It states an unconditional expected value as a weighted average of conditional expected values based on mutually exclusive and exhaustive scenarios. Why does that matter? Because it keeps our expected values totally consistent. If your probabilities don't perfectly align, your pricing will be off, and believe me, the market will punish you for it, creating profit opportunities for rival investors at your expense.
Here's the practical breakdown of how you build this forecast. First, you establish mutually exclusive scenarios, like declining versus stable interest rates. Then, you calculate the expected value conditional on the first scenario, and do the exact same thing for the second scenario. You weight each conditional expectation by the probability of that scenario actually happening. Finally, sum them up. The result, an ironclad, unconditional expected value.
Okay, we've reached the masterclass portion of this explainer, the ultimate tool for adapting in a dynamic world. Section 5, Updating Beliefs with Bayes. I absolutely love this concept. Instead of stubbornly sticking to our original forecast no matter what, Bayes' formula gives us a mathematically sound way to learn from experience. We update our prior probabilities the second fresh facts arrive. It essentially reverses the traditional flow of information. It uses the occurrence of an event, like a surprising news headline, to infer the probability of the underlying scenario that generated it. So the crucial part is following these steps. Step 1, what do you know right now? Imagine you estimate a 45% prior probability that a company, let's call them DriveMed, will beat earnings. But then, step 2, you get new information that they are massively expanding factory capacity. You have to ask yourself, what is the likelihood a company expands its factories if its sales are falling? Highly unlikely, right? We use that conditional likelihood to update our NAV.
When we use Bayes' formula to process that factory expansion, wow, look at how dramatically our investment thesis shifts. Our confidence in an earnings beat jumps from that initial 45% to a massive 82.3%. We didn't just guess that the stock looked better, we mathematically proved that our posterior probability, our newly updated belief, should practically double simply based on the precise likelihood of a company expanding factories while simultaneously missing earnings.
So what does this all mean for us? With expected value, variance, probability trees, and Bayes' formula now locked into your quantitative toolkit, you are equipped not just to predict the future, but to dynamically master it. So how will you apply this logic tomorrow? The next time a headline breaks, don't just react. Update your priors, follow the math, and let conditional probability guide your strategy. Thanks for joining me on this explainer.